Morning, everyone. Thank you very much for joining us today. So today we're going to do a webinar about the recent changes of the VAT law. VAT has been around in the UAE since 2018, and this is the first time there's been a major update in the rules. There's been quite a number of clarifications that have come out in terms of the rules, and you can find that on the FTA website. But this is, the first time that the actual law has been amended and changed since it started. These rules are effective from the 1st of Jan. So you need to obviously make sure you're prepared for that. And we're gonna go through some of the highlights of the changes that's affected mainly small and medium-sized businesses. There's a few other changes that we won't go into because they're not relevant for us and our audience, but you can find them there anyway. My name is Rayhan. I am the managing partner of an accounting firm called Alpha Pro Partners. We specialize in providing accounting services for small and medium-sized businesses. We also look after Xero implementations. We are also Xero Platinum Partners, and we will soon be supporting corporation tax, and we'll also be doing launching a outsourced HR services later on next year. We will do Q&A at the end of the session. Yeah. So this webinar is disclaimer. Obviously, we'll give you the lowdown on what's happening in terms of the changes in the law. But your role should be to seek professional advice. Whether you take on the advice or the information we provide or not, you still need professional advice regardless. We're obviously happy to support you from that point of view if you want to contact us separately after this webinar. So, like I said, the law number 8 of 2017 was issued in August, and it was effective 1st of Jan 2018. Now, the amendment that was issued on the 26th of September is effective from the 1st of January 2023. So this January, a lot of the changes will come into play. 25 articles have been amended, and they also introduce one new article. So if you're not already aware of some of these changes, I suggest that, obviously we're going to go through some of these changes in this webinar, but there's a lot of changes that will need to be happening for a lot of accountants and accounting departments to ensure that you're compliant with the new rules effective 1st of January. I'm going to go through like I said, I'm going to go through some of the amendments and changes that are happening from the changes of the law. And highlight what the things that you'd probably need to focus on to ensure that you're compliant. Now, in terms of the article number 1, there's been a few changes in definitions. So, for example, you've got additional definitions for charitable activities, pure hydrocarbons, tax evasion. So tax evasion was not a definition in the original law, now it is. Tax audit, tax assessment, voluntary disclosures, and tax procedures law. VAT is obviously new in the UAE, and it will continually evolve as the UAE matures as an economy. So I would expect amendments in the law over the coming years as the law becomes a lot more mature and keeps up with the changes in business. Business is always changing. There's always new things happening in the economy. And the rules obviously are keeping up with some of these changes as well. In terms of Article 7, so Article 7 goes over supply in special cases. So outer scope transactions, there's been an additional article that has been included in that. So, previously, if you was to sell or issue a voucher which was received for consideration, then that would be out of scope. Once upon a time, we had a client that was issuing vouchers, and that was also out of scope as well. But now if you're transferring an independent part of a business from a taxable person, from a person to a taxable person for the purpose of continuing the business that was transferred, then that would also be treated as out of scope. So obviously, in some cases, that may mean when you're selling a business or when you're selling a part of a business to another person. This is a big one. So registration exceptions and deregistration. So before, when many businesses, they were, they started a business in the UAE, and they may have had more than the mandatory threshold of revenue, but all of it is zero rated. So for example, there may be a company that provides services outside the UAE, all of that, they don't charge VAT because they are eligible not to charge VAT on their supply, as it's zero rated. They will only be they'll only be claiming back the VAT. Now, this new article basically means that you can apply for an exception from VAT registration as a result of making zero rated supplies. So what that means is, if you're always only going to make zero rated supplies, you can elect to be deregistered if you wish. Now, this is beneficial for many businesses because it will mean that you won't have to file a VAT return every quarter. Being under the VAT regulation means that at any moment of time you could be audited, and also the downside is obviously that you would have to, you can't claim back your input VAT. But if you are, practically speaking, if you're always trying to claim back VAT from the FTA, there is a process that you have to go through to claim it. It's not an automatic refund that you get from the FTA. You have to go through a mini audit before they give you that money. So in some cases, it's obviously saving a lot of time, and obviously for some businesses who are actually claiming back the VAT, it's not beneficial. But for other businesses where they don't want the burden of filing VAT returns every quarter, that would be quite beneficial for them. The authority may also deregister you as well, and that's necessarily to keep the safety of the tax system. Obviously, there's a lot of subjectivity in terms of what does necessarily to keep the safety of the tax system. You could argue that one example is you may have a company that's literally only doing only recovering VAT, and they're not paying VAT, and you could argue that that's one of the reasons why the FTA would want to ensure that the tax system isn't being abused. So yeah. Sorry, I think I've just been through that one. Date of supply. So there's been a new amendment to the date of supply. So obviously, the date of supply is usually the earlier of the date of issue of the tax invoice, or the payment due as shown in the tax invoice, or when the payment's received. Now they've added another clause saying 1 year from when the goods or services were provided. And from a practical point of view, that would basically mean, let's say, for example, you provided the supply, you sold some goods or you sold services, and you haven't had a chance to invoice your client yet. There's a time limit now, and that time limit is 1 year. So that's something that a lot of accounting departments, procurement departments, and sales departments would need to change their processes and to ensure that they keep track of when the goods or services were provided. And so that's an additional process that many companies would need to take into consideration when they are complying with VAT. Place of supply is another section as well. So Article 27, place of supply of goods. The place of supply of goods that includes import or export should be considered as in the UAE, where the transfer of title takes place in the UAE. So this is obviously quite new as well. So, if the place of supply of goods, which includes import or export, should be considered in the UAE where the transfer of the title takes place. So you may have goods or services which are sold somewhere else, but the actual title is actually being taken place in the UAE. You probably need to make sure that if there's a VAT treatment that needs to be taken, that you're applying the VAT. This is obviously subject to understanding the nature of the transactions that you're doing, but it's something that businesses will need to take into consideration. Just because there's an element of import or export in that transaction doesn't necessarily mean that you can by default zero rate or reverse charge that transaction. You may need to also take into consideration whether that title transfer of title takes place in the UAE. Place of supply in special cases. The place of supply for transport-related services shall be where the transportation starts. That will obviously affect logistics companies. The agent. The place of residence of the agent will follow the principle in certain cases. So there's times when there's agents that are transacting on behalf of the taxpayer, some of the agents may be based in the UAE, sometimes they may not be, and so that also now needs to be taken into consideration. So when you're using an agent to support you with your VAT transactions, you would need to ensure that you have additional processes in place to ensure that your tax treatment of those transactions are correct. Value of deemed supplier for related parties. Now, I think this is tied in with the corporation tax law. The corporation tax law came out quite recently, and in the corporation tax law, there's a lot of clauses with regards to related party, especially with transfer pricing, and especially with let's say, for example, you was to pay a related party an amount to reduce your tax, for example. There are certain rules that will govern that in the corporation tax law. Now, from an Article 36 point of view, the value of supply of or import of goods or services between related parties should be considered equal to market value. So that term market value is also quite common in the corporation tax law as well. The following conditions should be met. The value of the supply is less than the market value. So it has to be market value if you're selling at a lower value. And if the supplier is a taxable supplier and the recipient of goods or recipient of services does not have right to recover the full tax that would have been charged on such supplier as input tax. Now, the other thing, obviously, that sometimes happens is there may be transactions that are going through, for example, customs, and a lower amount is put through. This basically stops that. So you pay the full customs and you record the full amount, the full value of the goods on your VAT return. And obviously it will ensure that, let's say you're providing services, you're providing at the market value and not not at a lower amount. If you was to record that in your books in the corporation tax regime, it means you're recording lower costs as well. So this is all part of the maturity of the tax rules happening in the UAE as well. So from a practical point of view, if you are selling or paying for goods or services and it's below market value, there needs to be a red flag. It needs to be at market value to ensure that you are compliant with Article 36. Import of certain supplies, goods and services subject to zero rate. So the amendment article now includes import of the following supplies, which may be zero rated as well. This is just a list, so I'll just read through it. So import of transportation, import of goods or services related to the means of transportation, import of rescue aircrafts or vessels, import of crude oil and natural gas, import of basic health goods, and import of precious metals. So yeah. Tax recovery. Now, Article 55 is there's quite a lot of this is a major impact in terms of the way you would do your VAT return now and how you calculate it. The amended article now outlines documents required to support the recovery of import tax on importation of goods and services. So imports of goods and imports of services. Now, when you reverse charge, you're allowed to reverse charge goods and services if you're compliant with the rules as per the VAT law. What does that mean? That means that when you enter your reverse charge in output and input, it effectively becomes it nets it all off, so you don't have to pay VAT. In this situation, then they now adding additional requirements to ensure that you can reverse charge. So, for example, when it comes to import of goods, what happens in the FTA system is when you're processing your imports in customs, it is automatically linked to your VAT return, as we all know. So the amount that's been recorded in imports is in your VAT return, and it's on the output section, which means by default you're paying VAT on that. Now, if you are fulfilling the specific requirements for a reverse charge, you can then put it in your input box, and then it will net off and you don't pay the VAT on that because you have fulfilled the requirements to be able to reverse charge. In that situation, when it comes to goods, you need to make sure you have the correct documentation in place. If you do not have the correct documentation in place, then you can't reverse charge. Therefore, you have to pay the VAT on the imports. Now, what do you need to do to ensure that you comply? If you're doing the imports yourself as a company, you'd obviously need to make sure that you have the relevant documentations in place to allow you to import, to allow you to reverse charge on those imports. If you're using a freight forwarder, my advice would be to ensure that they are at least audited by a tax agent to ensure that they do have the correct processes in place, because you rely on them to provide you with the paperwork. And if they're not providing you with the correct paperwork, then it will fall on you at the end of the day, because it's your VAT that you're submitting. So I would advise you to ensure that any agents, any freight forwarders have the correct procedures in place, and that you insist on that. When it comes to services, you would need to make sure you have an invoice. This also falls in line with corporation tax, because when your import of services will be part of your supporting documentation for expenses. So you would need to do this anyway once corporation tax kicks in. But the key thing about this is many imports of services are subscriptions and paid ads, and those kind of things. So, if you've got legal advice or accounting advice from an overseas firm, that obviously you'd assume most of the time they give you an invoice, you record it into your books, record it as reverse charge, and you record it as reverse charge in the VAT return. The problem with subscriptions and paid ads in many cases is you make an automatic payment and you don't always get the supporting documentation. You have to literally log into the platform that you're using, pull out the invoice, record it into your accounting system, and then record it as part of your calculation of your VAT return. You would need to make sure that whoever's paying for subscriptions, they give you the invoice and the supporting documentation, because the consequences are you would have to pay VAT on behalf of the overseas supplier. So let's say, for example, you're using Gmail, the Gmail service, and they're not invoicing you with VAT, for example. You would normally reverse charge it. So it goes into your output and input sections of your VAT return. Now, if you're not receiving the invoice, what this now means is you'd have to put it on your output of your VAT return, but you can't put it in the input, which means you're paying VAT on behalf of Google because they're providing services in the UAE, and you have to pay the VAT on their behalf, right? So that's something you'd have to, that's quite a big one for a lot of our clients anyway, because a lot of our clients have a lot of subscriptions. So making sure that you have those records in place is very important. And you're going to need to anyway once corporation tax kicks in. Article 57, recovery of tax by government entities and charities. Input tax for sovereign activities, government entities, or relevant charitable activities shall be recoverable. Again, Article 56, input tax paid before VAT registration. Again, this is also quite a big one as well. This is not new. So there was always a article on input tax paid before VAT registration. And this is basically governing let's say you started a business and you don't hit your threshold for the next 12 months, for example. But you've already paid for expenses, right? And these expenses are VAT. So on your first VAT return, you'd want to know, can I claim back the VAT since the business started in the VAT on my VAT return? So my first VAT return is not, so heavy. So here there's a lot more. There's some amendments to this article. First one is goods and supplies. If they were not used to make taxable supplies, you can't claim it back. Second thing is, if they're part of capital assets and they depreciate before the date of registration, then you can't claim back the VAT. So what does that mean? Let's say, for example, you set up a restaurant and you spent quite a lot of money on the fit out, and you got VAT invoices for those fit out, but you happen to start the depreciation before you registered. This basically means that you can't claim back the VAT now, because you've already started the depreciation before the date of registration of your VAT. Services received 5 years prior before registration. So maybe you've been in business for, say, 6 years, and on year 6 you registered for VAT. Any of those services that was prior to the date of registration, you can't claim back. And then goods moved to another implementing state prior to the tax registration in the state. This is a bit of a gray area because implementing state it's quite subjective in terms of what is an implementing state and what isn't. The GCC hasn't yet formed its customs union yet, as per the tax procedures law. So that obviously is a bit of a gray area, and I would obviously speak to your advisors to ensure that if you do have transactions of that nature, you're able to treat it in the correct way. Obligations to pay VAT, conditions and requirements for issuing invoices. Any person receiving an amount as tax or issuing a tax invoice in respect to an amount must pay such amount to the FTA. The payment of tax upon issuing tax invoices was not given in the article has been added now. So amended is any person receiving an amount as tax or issuing a tax invoice in respect of an amount must pay that due to the authority, and this should be regarded as similar to the due tax under the provisions of this decree law. So let's say, for example, you issued a tax invoice and it had VAT on it. You need to pay that VAT to the FTA. Sometimes some companies, what they do is they would issue a tax invoice and maybe they're not VAT registered yet. They would need to pay, if they have issued a tax invoice, you have to pay the VAT. And in some cases, what some cheeky people do is they would, invoice someone and they're not VAT registered, and they'll add the VAT on it anyway, right? So this basically means even if you're registered, you have to pay that VAT to the FTA if you're going to charge it. Output tax adjustment. A taxable person shall adjust output tax after the date of supply only if the tax was charged in error, but also if the application of the tax treatment was incorrect. So this is just basically mentioning when you can adjust your output tax. Maybe you've had the wrong percentage through your system, or you treated the output tax as zero exempt. This is also a big one as well. Issue date of tax invoice. Tax invoice should be issued 14 days from the date of supply, even for special cases of date of supply provided under Article 26. So you can't delay in sending your tax invoices. You have to send it as soon as within 14 days of your date of supply. And that's also a big one as well. Some, there may be instances where you're not sending your tax invoice for whatever reason. This now stipulates there is now 14-day time limit. Also, credit note shall be issued within 14 days of instance of any tax output tax adjustment. So again, if you are making any adjustments of your output tax, then you need to issue a credit note within 14 days. And again, that's a procedural thing as well. So people within the whole company needs to be aware of this, whether they are sales, whether they're procurement, not just accounting as well, because this will affect the whole company. Depending on who does the sales, sometimes it could be a salesperson who does the sales, and they're not issuing the tax invoice within 14 days. It could be you have a very long approval process. The supplier has been done, and it takes a long time for you to approve, the invoices to be sent out. So you need to make sure it's shortened so you don't fall foul of this 14-day rule. You may have a system, you may be using an ERP, and the ERP may not be churning out the invoices as quick as they should be. So again, you need to look at your processes pretty much now and ensure that you don't fall foul of this 14-day rule as well. Introduction of new Article 79, Statute of Limitation. The FTA may not conduct a tax audit or issue a tax assessment to the taxable person after the expiration of 5 years. So you've got a 5-year period before the FTA issues you with a tax audit or tax assessment. Obviously, VAT went live from 2018, so we're in year 4 at the moment. However, if it relates to tax evasion or non-registration, the period which the FTA can do an audit goes back to 15 years, right? So, that you have to, most people obviously are quite honest and, make sure they do the tax as compliant as possible. But, if, for example, there's tax evasion or you haven't registered for whatever reason, they can go back 15 years now. So, you need to make sure that your processes are watertight. If you're not registered at the moment, make sure you check whether you do need to register. And there's no harm in making sure you have some sort of tax audit via a tax agent, just to make sure that your processes are in accordance to VAT. Because once this law kicks in, some of your processes may not change, and I would always advise that you get advice from a tax advisor to ensure that your processes are now in line with what the new rules or even the existing rules require you to do. So if you do have an audit, you're not finding any surprises. You know straight away what your weaknesses are, and you can make those amendments before this ever happens as well. So something to think about. Article also permits amendment of the referred periods by virtue of a separate cabinet decision. It should be noted that voluntary disclosures are not allowed to be submitted after 5 years from the relevant tax period. So this is also quite big in a sense that, as I mentioned from the last slide, you can get a tax advisor or tax agent to review your VAT and just to do an audit to ensure that you're fully compliant. Now, you've only got, after the 5 years, you can't make any voluntary disclosures, which means that if you do find an error on year 6, for example, you can't make the amendments via voluntary disclosure in your VAT return. So this is also quite a big thing that you need to take into consideration to ensure that you are compliant, because once that 5-year period goes, you won't be able to amend any VAT returns that you may have. In terms of the executive regulations, so Article 3, supply of services. There's a new clause, clause 2. It states that the function of a member of a board of directors performed by a natural person appointed as such for any government entity or private sector should not be considered as a supply of services, which means that if you're a, if you're on the board of directors and you as an individual, not as a company, as an individual, are compensated for that, and you could be, you could be paid not from a payroll, but you may invoice them, then that's not supplier services, so therefore you wouldn't charge VAT on. So yeah. New record keeping requirements. This is also an executive regulation, place of establishment. If a taxable person does not have a fixed establishment, he must keep records of the transaction to prove the emirate in which the place of establishment is located, if he has place of establishment, or to prove the emirate in which the supply is received, if he does not have a place of establishment. So this is a tax. This would relate to the taxable person. So someone who's VAT registered, they have an overseas company, and they are VAT registered in UAE to collect and pay VAT. This will be applicable to them, and they'll just need to make sure that they have strong record keeping processes to ensure that they're compliant with this new executive regulation. Another new one, this probably won't affect small businesses, but I've put it in there anyway. New record keeping for e-commerce. So if you are a e-commerce business and the value of your taxable supplies exceed 100 million dirhams during a calendar year, then you must keep records of the transactions to prove the emirate in which the supply is received. So for most e-commerce businesses, you probably could do that if you've got a good platform that tracks the, the delivery addresses of where you're sending your products to. Maybe some don't, but what you'd want to make sure of is if you do get to that level, you need to make sure that you do have those records in place to ensure that you're able to prove which emirate the supply went to. And that's it. Thank you very much. If you have any questions or answers, feel free to put them in the chat and I can answer them for you. If you want a copy of these slides, we can provide that for you. Just contact us after this webinar and we can share the slides. Also keep in mind that the law is also available on the FTA website, so you can find it from there as well. I've got one person putting their hand up. If you can just type in your question, I can then answer it. Sirajuddin Mohammed Kareem, if you can just type in your question. If, for example, you have questions after this webinar, feel free to contact us as well. Our contact details are on our website, and one of our tax consultants can be in touch to help you in your questions that you have. We also partner with tax agents as well, so anything very technical, we can then refer you to our tax agents to support you with any additional requirements that you may have. Okay, I've got some questions already, so I will start answering them. First question is Article 15. Let's go back through. So Article 15, registration exception. So what this basically means is, if, for example, you are making zero rated supplies only, and you're not going to make any standard rated supplies, then you can apply to make an exception from registering for VAT. So, the rules state that if your revenues are more than 375,000 dirhams, then it's mandatory required for you to register for VAT, right? Whether you are zero rated, whether these are zero rated supplies or standard rated supplies, right? So whether you're charging VAT on them or they're zero rated. What the rules state now is, if, for example, that you are only making zero rated supplies, you have to apply for an exception with the FTA. So you have to actually apply for it. You can't just say, I'm not, I don't need to apply for, I don't need to register for VAT. You have to make sure you apply for that exception with the FTA. So you have that certificate or that confirmation to ensure that you don't need to register for VAT. Next questions. For subscriptions, they only usually supply a payment receipt and not an invoice. Will that suffice as supporting documentation? In my opinion, a receipt is not enough. A receipt is confirmation of payment. It's not a confirmation of your supply or your supplier services. So I would highly recommend that you ensure that you get an invoice from the company that's providing subscriptions. Usually that you find them in the place where you can't find them. So usually they're like in the admin section in most kind of subscription SaaS businesses, and you can pull it out from there and enter it into the system. It's always, you could always ask, you can always get support from, contact the support of the SaaS product to then get those invoices for you. Most jurisdictions have to provide invoices anyway, so I'll be very surprised if they only provide a payment receipt. Next one is okay. My question is, so there's a question about the VAT being at 5%. Is it increased or is it the same? We'll all be pleased to know that it's the same. It's still at 5%. I haven't heard of any rumors of that being increased. Obviously, Saudi increased it from 5 to 15%, but with corporation tax coming in, at the moment it's still the same. More questions. We're a non-profit company whose revenues are mainly from memberships and contribution fees. Can we apply VAT exception or deregistration? For non-profit companies, I would get advice from a tax agent to understand your specific situation and to then give you the appropriate advice in terms of whether you charge VAT and whether you can apply for exemption or deregistration. Obviously, there's a number of, being a non-profit, is stated in the laws, but you'd have to obviously fulfill the requirements of being a non-profit as well. So I would make sure that you get some sort of advice from a tax agent who can help you with that. Any new amendment if it is situated in safe zone? There's no amendments in terms of whether, if with regards to safe zone, there's still got that, you still have that terminology of designated zone, and in terms of designated zone, those the free zones which are referred to as designated zones are on the FTA website, so you can find that list there. Another question: how to claim back VAT paid on invoices issued in 2020 and 2021, and are deemed uncollectible anymore. I'm assuming these VAT paid on invoices where you issued the invoice in 2020 and 2021 and you cannot collect it anymore. Just be aware that there is a in the VAT law for debt for any invoices that are written off as per bad debt. You can claim back the VAT, but there are certain requirements that you need to do. One of the requirements, I believe, is you have to wait 6 months. And then there's other things that you need to do. You have to write off from your books as well. But again, if you contact us, we can obviously, give you the advice in terms of the processes that you can follow to ensure that you can claim back that VAT. Another question I want to confirm regarding the issuance of credit note. It says within 15 days from the tax adjustment, not from the date of invoice, right? If the sales invoice is dated 30th of November 2022, then it will be included in VAT return in 20th of December 2022. Adjustment was made known in December 29. So counting will start from December 29, not November 30th. So in terms of this question, where you wanted clarity on confirming the issuing of a of a credit note within 15 days from the tax adjustment date. Obviously, there's a few things you need to take into consideration. One is the fact that you're issuing a credit note on a tax adjustment, and the other is that you could issue a credit note based on commercial reasons, right? So for example, you may have invoiced someone for 10 apples, right? And you delivered 9, and you got to give a credit note for that 1. So that's from a commercial point of view. You'd need to ensure that there's a number of things that you're doing as from a process point of view to ensure you have the correct documentation in place that you can then create your credit note. So from my point of view, if you are issuing a credit note on any tax adjustments, you'd obviously need to make sure you have the correct documentation and processes in place to ensure that you can issue the credit note. The other thing is obviously you need to make sure that it's within 15 days, right? So you need to follow that rule in terms of when you do your VAT returns next year. If you want specific advice in your situation, feel free to reach out to us, and we can have a separate session on that as well. Question: what are the implications under tax point of view for payments made for flight ticket acquisitions for which companies do not release invoices? Again, this one is a bit vague, so I'd say if you just want to contact us, we can walk you through that scenario and support you from that point of view. My second question, this is from Sirajuddin. My second question is, what if we make tax invoice and then the client cancel the deal? So in that case, what can we do? Again, it's quite vague. It's quite vague in terms of what you can do. I mean, if you issue an invoice and your client cancels a deal, let's say, for example, you offered some sort of service to them, and then they signed a contract and then they literally cancelled it. You'd need the documentation to prove that 14 days hasn't gone past. So you'd have to get some sort of confirmation on email from them to say that they've cancelled, and then I would issue the credit note, because the onus is on you. Have to prove that 14 days you haven't gone past the 14-day limit. And one of the ways you prove the 14-day limit is by ensuring you have the documentation in place. So what the 14-day rule does is it puts the onus on you, the taxpayer, to ensure that you have the documentation to prove that you're complying with the requirements of the law. So another question, Article 55. For all international subscriptions as Google, Gmail, for which are not supported with invoices, only payments, receipts, do we need to output VAT and pay for each one? And do not input VAT in order to claim. So yeah, so this is my point about the reverse charge and it being quite a major one for many companies. My view is receipts are not enough. You need to have invoices, because receipt is just a confirmation of payment. It's not a confirmation of service. From my point, what the rules stipulate is, if, for example, you do not have the supporting documentation of your reverse charge, for example, then you have to pay VAT on behalf of Google, for example. So you have to, you'll have to enter it on the reverse charge box in output, and you can't record it in the reverse charge box in input, which means you're now paying the VAT on behalf of Google. And so that's basically because you haven't fulfilled the requirements of a reverse charge. You can only reverse charge goods and services when you fulfill the requirement. And if now the requirement is you need to have an invoice copy of your invoice from Google. If you don't have that, you don't fulfill it. Therefore, you have to pay the VAT on that. I think we're running out of time, and I'll wrap this up. We have lots of questions for this webinar. What I suggest you do is, if you would like to reach out to us with any specific questions, we can, myself or our tax consultant can sit with you and go through any specific questions you have. Like I said, we work with tax agents as well. So any very complicated cases that you need specific support on, we can pass you your details onto them, and then they can help you from that point of view. We are recording the session and we'll share it after in the next few days. Yeah, hope you guys have enjoyed this webinar and you've got a lot from it. The rules are available, the full rules are available on the FTA website. I do encourage you to read it, go through it, and make sure that your company complies with the new requirements. We're more than happy to support if you need that support. And over the next 12 months, we'll be doing more webinars on corporation tax, on HR, on Xero. And it will be myself and some of the members of our team who will be supporting you in those webinars as well. Thank you very much, guys.